Warren, in the past, you've enjoyed discussing accounting for options grants. So I'm curious, what's your view of the new accounting standard which mandates that companies report lower tax provisions based on so-called excess tax benefits enjoyed when share-based compensation ends up being more profitable for the grantees than when it's initially modeled? These so-called benefits, excess benefits, used to go through the shareholders' equity line on the balance sheet. Which accounting method makes more sense to you, the old method or the new?
Johnny, I think you know a lot more about it than I do. So if I were asked to answer that question, I'd probably call you up and say, what should I say? It's not a factor that will enter into Berkshire, so I really have not. I mean, I've heard just a little bit about that accounting standard, but I really don't know anything about it. Charlie?
It's not a big deal.
Yeah, well, I know that. Yeah. There are a few things in accounting we really disagree with, and whether they might be material to somebody trying to evaluate Berkshire. And that primarily gets into amortization of intangibles. It certainly gets into realized capital gains and that sort of thing. And we will go to great lengths to try to tell our partners, basically, not all of whom are accounting experts or anything. And we will try to make clear to them at least what our view is. The same way as if I had a family business and I was talking to my sisters or something about it. But unless it's material, we'll probably stay away from trying to opine on any new accounting standards. If it's material to Berkshire, we'll go to great lengths to at least give our view. Charlie?
Well, I certainly agree with that.
Okay.
That what he's talking about is not very material to Berkshire.
No, it isn't, and it really won't be.
No.
Some of these others are those, and we will bring those up as they come up. We are reporting $400 and some million less in our earnings than if Precision Castparts had remained a public company. Well, is Precision Castparts, I mean, are the earnings less real? Is the cash less real? Is anything? Because it's moved the ownership? I don't think so. And I want to convey that belief to shareholders, and they can debate whether it's right or wrong. But I think it's a mistake not to comment and just assume that the owners understand that, because it's a fairly arcane point, and so we point it out. But we also point out if we think depreciation is inadequate, as for valuation purposes, that depreciation is inadequate at a very capital intensive business like BNSF, which I must say, still love anyway. Charlie, any more?
No.
Okay, section 5.